Hello everyone, and welcome to the channel. We live in a country that keeps talking like a startup and spending like an empire in retirement. The official line is simple and soothing. America is the richest economy on earth. The dollar is king, the debt is manageable, and there is always room for one more program, one more war, one more rescue package. The only problem is that the math stopped matching the story a while ago. When the line item called interest on the debt quietly grows into something the size of the Pentagon or Medicare. This is not a technical detail. This is the moment when the budget stops being a policy tool and turns into a slow-motion, self-cannibalization machine. Here is the uncomfortable number to keep in your head. Annual federal interest payments have already climbed into the high hundreds of billions of dollars per year and are projected to move toward and then beyond what the U.S. spends on its armed forces. Depending on whose forecast you read, that crossover point is either already close or arriving within the next few years. The exact year is less important than the direction. More of your tax money goes not to roads, schools, or even tanks, but just to servicing yesterday's decisions. And this is where the official story falls apart. For years, Washington lived inside a very comfortable illusion. Ultra-low interest rates meant that you could pile up debt at almost no visible cost. The federal government ran deficit after deficit, rolled over old bonds into new ones, and the interest line in the budget looked almost polite. With rates near zero, you could borrow trillions and still say with a straight face that debt service is manageable. That world ended when inflation hit and the Federal Reserve was forced to push rates up several percentage points in a very short time. The stock of debt stayed huge, but the price of rolling it over changed brutally. In simple terms, imagine a household that refinances its mortgage every few years. If you refinanced from 7% down to 2%, you felt smart and safe. If you now have to refinance from 2% back up to 5% or more on a much bigger principal, you don't feel smart anymore. You feel trapped. The U.S. federal government is that household, except instead of a few $100,000 in debt, it is carrying tens of trillions, and it cannot downsize the house without triggering a political earthquake. Here's the part economists fear. Debt does not sit still. Old bonds mature every month. New ones are issued to replace them, plus extra to cover the current deficit. When the average interest rate on the debt creeps up, the government doesn't feel it all at once. It feels it like a rising tide. Year after year, a larger share of outstanding debt is now priced at today's higher rates. You don't need any conspiracy theory here, just arithmetic. If the average coupon on your debt doubles, the annual interest bill moves in the same direction. In short, the math doesn't care about ambition. The United States entered this new interest rate reality with a federal debt held by the public, roughly around the size of its entire annual GDP, and a total gross debt that comfortably clears the 30 trillion plus mark. Again, the precise decimal point depends on the day and the data series, but we are nowhere near the world of modest debt anymore. You have a very large stock, and now you've added a much higher price per unit. If a government with a 10 trillion debt pays 1%, that's 100 billion per year. If a government with 25 to 30 trillion of debt pays something around 4%, you can see where the numbers go without a calculator. This is the flaw you can't fix with PR. The official line from both parties has been a kind of magical thinking. On the Democratic side, we just need a bit more spending to fix infrastructure, smooth out inequality, and fund the green transition, and then growth will take care of the rest. On the Republican side, we just need to cut waste, keep taxes low, and somehow the revenue fairy will appear from higher growth, while defense remains sacrosanct. In reality, both tribes have voted for tax cuts, wars, stimulus packages, and entitlement expansions when it suited them. The one thing nobody wanted to touch was the underlying structure: chronic primary deficits and a political culture that treats borrowing as painless. If you strip away the slogans, the federal budget has three big, sacred pillars: Social Security and Medicare on the mandatory side, defense on the discretionary side, and now interest on the debt as an involuntary fourth pillar. Social Security and Medicare together absorb a very large share of federal outlays, reflecting an aging population that was promised a certain standard of retirement and healthcare. Defense, even after Afghanistan and Iraq, still demands hundreds of billions per year to maintain global bases, carrier groups, and the usual catalog of foreign adventures and commitments. Interest is not decided by a committee. It arrives with the Treasury's refinancing schedule and the Fed's rate decisions. Public rhetoric is, we must protect our seniors, our troops, and our future. Private budget spreadsheets say interest, entitlements, and defense are eating the table. Everyone else can fight for scraps. When you compare interest payments to federal spending on education, infrastructure, or R&D, the picture becomes almost comical. Money that could have gone into long-term productivity instead goes into making bondholders whole for the privilege of holding U.S. paper. So, let's take a breath. Where are we now? We have a federal government that runs deficits even in relatively good years, a central bank that had to jack up rates to control inflation, and a stock of debt so large that every percentage point on the average interest rate means tens of billions extra in annual cost. The number nobody likes to mention is simple. Interest is sliding into the top 3 categories of federal spending and is on track to compete directly with defense and major health programs. Here's the number nobody likes to mention. If interest payments continue to grow faster than tax revenue, the political debate about left versus right spending priorities becomes theater. The real conflict becomes interest versus everything else. You can promise better schools, cheaper healthcare, or more tanks, but if an extra slice of the budget is already pre-sold to past borrowing, someone is lying about what can be delivered. This is where theory hits a brick wall. For 40 years, Washington sold the idea that deficits don't really matter as long as growth is fine and inflation is low. Now you have inflation that was high enough to trigger a rate shock, growth that is not spectacular, and a level of debt that makes every rate hike a budget grenade. Politicians still go on television and talk about new programs as if the slate is clean. In reality, a huge invisible program called Pay Interest on What We Already Did is quietly swallowing fiscal space, and it doesn't care about your campaign promises. Let's zoom out for a second. Who are the players in this little drama? First, the White House and Congress, who decide the nominal budget. Second, the Federal Reserve, which sets short-term rates and signals the path of money. Third, the bond market. Domestic investors, foreign central banks, funds, and institutions that actually buy the debt. Fourth, the electorate, which has been trained for decades to expect low taxes, high benefits, and endless rescue when things go wrong. Add to this a set of powerful lobbies, defense contractors, healthcare giants, financial firms, senior organizations, all of whom see any serious cut as a declaration of war. The White House, regardless of party, wants to do 3 things at once: manage geopolitical competition, particularly with China and Russia, maintain internal social peace with welfare and transfers, and drive structural transitions like decarbonization. All 3 cost money. Nobody wins elections in the U.S. by saying, "We will cut your benefits and your defense umbrella to pay our bondholders." So the natural tendency is to pile the difference on the credit card. Congress is structurally worse. The short electoral cycle pushes representatives to think in 2-year slices. Long-term fiscal responsibility is a slogan for hearings, not a real constraint. Both parties have their own sacred cows. Democrats will die on the hill of Medicare, Social Security, and various transfer programs. Republicans will die on the hill of defense, certain tax preferences, and protecting their own voter blocs. The compromise is usually to not cut anything serious and to shout about fraud, waste, and abuse, which is politically convenient but mathematically irrelevant. Then you have the Fed. Its official mandate is price stability and maximum employment, not keep the government solvent. When inflation spiked after years of easy money and pandemic stimulus, the Fed had to slam on the brakes with rapid rate hikes. From a narrow central banking perspective, that was overdue. From the perspective of the Treasury, it was a nightmare. Your average interest cost on new borrowing jumps in a very short period, just as your stock of outstanding debt is near its historic peak relative to the size of the economy. Here's the part economists fear: the soft, unspoken pressure on the central bank to start thinking not only about inflation, but about the fiscal consequences of its decisions. If the government becomes too reliant on low rates to stay solvent without brutal cuts, the temptation is always there to tolerate higher inflation or to find some creative way of financial repression. Make savers accept returns below inflation so that the real value of the debt erodes quietly in the background. Historically, this is how many heavily indebted states have dealt with their problems: slow stealth default via inflation and controlled interest rates. You see the problem here, right? There are only 4 real ways out of a debt trap. You can grow faster than your interest costs for a very long time. You can tax more. You can spend less. Or you can default, either openly or through inflation. The U.S. establishment pretends there is a 5th option called innovation, efficiency, and better management. That sounds nice on television, but unless it shows up as sustained higher growth or lower structural deficits, it changes nothing in the budget math. Let's go down one level into the structure of the budget. A big chunk is mandatory spending: Social Security, Medicare, Medicaid, and some other programs which are basically on autopilot, driven by eligibility rules and demographics. Another chunk is discretionary: defense and non-defense, which Congress is supposed to vote on each year. Interest sits above this distinction because not paying it is called default. This means that as interest rises, the share of the budget that is actually negotiable shrinks. If you're watching from the US, ask yourself a simple question: which of these are politicians actually willing to cut in a meaningful way? Social Security, when you have tens of millions of retirees with a high propensity to vote. Medicare, in a country where healthcare costs are already a political minefield. Defense, when your entire foreign policy is built on projecting power globally. Or interest, which you simply cannot cut unless you blow up your own credit rating. From here, all options are bad. The only question is who pays first. For the average American, the most obvious channel is not a headline about bond yields. It is the creeping squeeze. When interest payments eat more of the budget, you are pushed toward one of 3 combinations: higher taxes, lower services, or higher inflation. Higher taxes can be dressed up as making the rich pay their fair share, but the middle class always gets pulled in sooner or later, whether through income tax, payroll tax, consumption taxes, or stealth measures like bracket creep. Lower services show up as underfunded schools, crumbling infrastructure, fewer public options, and a greater need to self-insure. Higher inflation shows up in rent, food, fuel, and healthcare bills. This is the quiet part, said aloud. The cost of money that rose in response to inflation is now coming back to the fiscal system as a cost of debt. The debt was accumulated over decades of bipartisan decisions to avoid serious trade-offs. Those decisions felt painless at the time because rates were low. The pain is now being delivered to people who did not make those decisions, and in many cases were not even alive when the key commitments were signed. This is not unique to the U.S. It is how most aging, indebted systems behave. But the dollar's status as the world's main reserve currency makes the American case systemically important. Here's the part economists fear. When interest becomes one of your largest budget items, you are effectively running a giant transfer machine from taxpayers and future program recipients to holders of government paper. Some of those holders are domestic pension funds and households. Some are foreign central banks and institutions. Either way, the political system is paying compound interest on its own cowardice. It could have chosen to run smaller deficits in good years or to tackle structural spending earlier. It didn't. Now the interest line is the enforcement mechanism. Let's zoom out again and place this inside the global context. The U.S. still benefits from something nobody else has at the same scale. Its debt is denominated in its own currency, and that currency is used globally for trade, savings, and reserves. This exorbitant privilege means there is still strong structural demand for treasuries. Foreign central banks, sovereign funds, private investors, they all need dollar assets. This is what lets Washington run deficits that would have killed the credibility of a smaller country long ago. But a privilege is not a blank check. If debt keeps climbing and politics looks increasingly dysfunctional, the risk premium doesn't stay at zero forever. Markets do not wake up one morning and suddenly sell everything in panic out of nowhere. They reprice gradually, then all at once when a trigger appears. The trigger can be a failed auction, a political crisis over the debt ceiling, a sharp change in Fed policy, or some external shock. The higher your starting debt and interest burden, the less room you have to absorb that shock without violent moves in rates or the currency. This is the structural vulnerability. You are not at immediate risk of classical default, but you are structurally more exposed to any future crisis. Does this look like strategy or managed decline? The irony is that both major U.S. parties still speak in the language of abundance. One side talks about investing in our future as if capital is free. The other talks about rebuilding our military and cutting taxes as if interest costs don't exist. The only place where reality surfaces is in dry, boring documents from budget offices and independent analysts, quietly warning that interest is eating a growing share of the pie. Those documents are treated like weather reports, mildly annoying, mostly ignored, until the storm hits. Meanwhile, on the ground, you have a generation of younger Americans facing high housing costs, expensive healthcare, student debt, and unstable work patterns. They are told that the country is spending mind-bending sums on their behalf. What they actually see is that their own balance sheet doesn't match the rhetoric. When they finally connect interest payments on a national scale to their own future tax bill and reduced services, don't be surprised if political radicalization accelerates. A system that promised opportunity and prosperity, but delivers servicing the past, tends to lose legitimacy quickly. What does all this mean going forward? First, any serious fiscal consolidation would require breaking at least one taboo: touching entitlements, touching defense, raising broad-based taxes, or tolerating significantly higher inflation as a way to erode debt. None of these are popular. Each produces its own backlash. Cutting Social Security or Medicare infuriates older voters. Cutting defense triggers the security establishment. Raising taxes hits donors and corporations. Letting inflation run higher for longer erodes savings and purchasing power and hits the poor the hardest. Second, the longer you delay choosing, the more the choice is made for you. If you assume that interest rates will magically fall and stay low again, you are betting that the inflation shock was a one-off event and that the world will return to the pre-2020 financial environment. That is a brave assumption when supply chains are being rewired, geopolitical tensions are rising, and the energy transition is far from cheap. If, instead, we are in a structurally more inflationary, fragmented world, then the low forever rate regime is gone. In that world, high debt and higher rates are not a passing inconvenience. They are the new normal. Third, the political system is structurally bad at planning for any of this. Incentives push leaders to shift pain into the next term, the next administration, the next generation. The result is a kind of rolling can kicking, where each short-term fix, a temporary spending cap, a cosmetic reform, a one-off windfall, is advertised as a solution, while the underlying ratios keep deteriorating. Debt relative to GDP creeps higher. Interest relative to revenue creeps higher. The distance between the speeches and the spreadsheets grows. You see the problem here, right? This is not a morality play about good or bad politicians. It is a structural story about a system that rewarded every actor for short-term comfort and punished almost nobody for long-term risk. Voters wanted benefits without taxes. Politicians wanted re-election without hard choices. Central bankers wanted stability without confrontation. The bond market wanted yield without drama. Put it all together, and you get a country where one of the fastest growing budget items is literally pay interest on everything we didn't want to decide honestly for 40 years. In the end, the question is not whether the U.S. can service its debt tomorrow. It can. The question is what kind of country you get when more and more of your collective effort goes into servicing the past instead of building the future. A state that spends huge sums on interest, plus locked-in entitlements and a vast security apparatus, has less and less room to invest in the things that actually increase productivity: education, infrastructure, basic research, and the kind of industrial policy that produces real, tangible capacity, not just financial engineering. For households and small businesses, the translation is brutally simple. Credit becomes more expensive and more volatile. Fiscal policy becomes an exercise in reallocating pain rather than expanding opportunity. Each crisis, whether financial, geopolitical, or environmental, meets a state that is already fiscally stretched. The margin for error shrinks. The appetite for honest conversation shrinks with it. Because no faction wants to admit the scale of adjustments required. This is how great powers slide, not collapse. Slowly, through a series of rationalizations, half measures, and comfortable lies, until the system is so constrained that even moderate shocks produce outsized damage. The U.S. is not there yet, but interest payments, eating into the core of the federal budget, are a very clear structural warning. You cannot permanently run an empire on a credit card and expect no consequences. Thank you for watching. Take care of yourselves and your loved ones, and try to remember, slogans don't power grids, systems do.